Hey guys, Akil here, and welcome back to another weekend edition of The Trading Edge. If you guys are new, welcome. I'm a professional currency trader. I'm also a trading coach over at tier1trading.com. And well, The Trading Edge is a daily video that myself and my trading partner Jason Greystone produce each and every day for our Tier 1 clients, showing them what's on our radar. If you're interested in becoming a member over at Tier 1 Trading, we have a 14-day trial where you get access to trading courses, you get access to these daily videos, software, and a whole bunch more. So you can click the link below this video if you're interested. In today's video, we're going to look at two different trading opportunities, showing you two different trading strategies. We're also going to take more of an in-depth look at my trading statistics up to this point in the year. So let's hop right into it and take a look at the charts. So we're going to start off on the euro dollar here, and I'm on the weekly chart just to give you a bigger perspective of what's going on. And right now the euro is putting in a potential head and shoulders top. You can see after consolidating for about 2 years or so, we finally had a massive extension up, creating what could be our right shoulder, or excuse me, our left shoulder. We then have a retracement down, which is going to be the start of our neckline. I'll draw that in later. Our extension up here is going to be the head. And as we come down to retest that neckline, right, we would be looking for the right shoulder to form and a potential move lower to give us our head and shoulder top. So we don't have that yet, but bigger picture, if we do get a break of this neckline, it can open up the door for a very good shorting opportunity. Now, until we get that, the head and shoulders pattern is not valid. So although you want to keep it on your bigger radar, it isn't necessarily something that you want to involve yourself in right now. Something that you could look for is potential advanced pattern formations. If we go one time frame down to the daily, you can see that the market is essentially in consolidation. We have come down to a previous level of structure support. This level of structure support has held 1, 2, 3 times, and we're trading below our previous level of structure resistance as well. So we're right in the middle of two major structure levels, a previous level of structure resistance, which is on top, and a previous level of structure support, which is on the bottom. And typically in times like this, we say that the market is in consolidation, meaning that the market isn't showing us a true directional move in one way or the other. We don't truly have an uptrend. We don't truly have a downtrend. We're kind of just bouncing back and forth. And this is the perfect opportunity to look for advanced pattern formations, because just by the nature of how pattern formations are created with their series of extensions and retracements and extensions, we tend to see them in choppy markets or in periods of consolidation. And if we go down one more time frame to the 4-hour chart, we actually have two of them setting up on the euro dollar at the same level. So the first thing I want to do is I want to identify my most recent swing in the market. And this is going to be the start of my advanced pattern formation. We call this the impulse leg or the anchor leg. And we're going to label that X to A. And what I want to do is I want to take my Fibonacci retracement from that same leg, so our swing high up here, and swing low right there. And I'm going to look for which Fibonacci level is hit. And this is key because depending on which Fibonacci level is hit, that's going to dictate what pattern formation I'm looking for. Now, in this case, we do hit the 618. Now, we maybe hit the 618. So it all depends on you as a trader. And we've been talking to this with our Tier 1 clients all week. I personally look at the last 4 digits after the decimal. So you see our 618 retracement is right now at 117.20, right? I look at the 4 digits after that decimal. So 1720. If you're someone that takes, the 100th of a pip into account, that 5th number, you may or may not have a touch on this 618. So it's very important that you understand as a trader, how many digits do you look at and what are your rules for, is that 618 touched or is that 618 just missed? Because that's going to be the big difference between what advanced pattern formation you're looking for. And unlike some other educators out there, when we teach advanced pattern formations, there is some subjectivity. There's always going to be that in the form of the initial impulse leg. But as far as the rest of the pattern completion, so the B leg and the C leg and the D leg, it's either going to be black or white. We have very strict rules for what counts as a hit, what doesn't count as a hit, what pattern formation needs what ratio to be hit. And I find that especially with new traders, when you organize it that way, where there's no gray area, there's no room for them to make a decision and convince themselves to take a trade they're not supposed to, or scare themselves out of a trade that they're supposed to take, it makes it a lot easier for them to follow the rules, which makes it a lot easier for them to take consistent make consistent executions. And of course, consistent executions or consistent analysis plus consistent execution will equal consistent results. So something you need to think about. And if you haven't thought about that already, as far as how many decimals you look at, you probably want to do that over the weekend and make sure you write it down in your plan. So for me, this is a hit of the 618 retracement, which means I'm looking for a Gartley formation. So I'm looking for a pattern formation that will look like this. This is going to be my X to A, my swing high to swing low. And actually, I'll use a little pattern tool over here so you can see the X to A. My X to A right here, which is going to be my initial swing high to swing low, my anchor leg. This is going to be my A to B coming to that 618 Fibonacci retracement. This is going to be my B to C coming back down to retest the previous structure lows. And then I'm looking for a D completion right up at this 786 retracement here, which is 117.80s. Now, it's a shallower Gartley, so for risk-reward reasons, my entry is actually going to be a little bit above this level, but this is going to be the D completion point. And the reversal zone that we're looking at for this potential advanced pattern formation is going to be from this D completion, this projected D completion, up to the start of our pattern. So within this gold box, this is going to be the level where the pattern formation is technically triggered to where it's technically invalidated. Now, if we dig in a little bit deeper, and this is going to depend on what type of trader you are, let's just delete some of these notes here, get these lines out the way. We have another advanced pattern formation here as well. Now, I don't personally trade this pattern. I do like it, but I don't trade it for some specific reasons involving stop losses and risk reward and stuff like that. But we're also going to have a butterfly formation, right? So if we take the B leg, right, of our Gartley, and we measure this to be our X to A, right? We have an X to A. We have an A to B right here. Let's go ahead and make this a different color so it stands out a little bit. Yellow, is that going to work? Yeah, why not? X to A to B, B to C, and C to D that completes right up here at the same location as a Gartley. Now, there's many ways to trade a butterfly formation, but if you're one of the traders that trades it using the 127 inversion from the X leg, or excuse me, from the A leg to the X leg, you'll see that if I take my Fibonacci extension tool, if I draw it backwards from our X down here, remember this is, ignore the C, that's for the Gartley pattern. This is going to be the A leg, excuse me, of the butterfly. I'm probably confusing you guys right now, but hopefully in editing, I'll make it easier for you. This is going to be the A leg of the butterfly. Back to the X leg of the butterfly and back down, you're going to see that we have a 127 extension right at that level as well, which is what many traders use as the butterfly completion point as well. So here on the euro dollar, while we're in consolidation, we have both a potential bearish Gartley pattern and a potential bearish butterfly completing at the same level. So something you certainly want to put on your radar for the week ahead, especially if you are a pattern trader that trades any of these two pattern formations. Next, I want to head over to gold dollar, and this is a pair that we looked at a while ago projecting a downward move, and lo and behold, we got that downward move. You can see price action broke this level. This was the level we were looking at again, weeks ago, and we continued all the way down to our previous level of structure support, right? One of the things we always say is look left, structure leaves clues. We say that structure acts like a magnet, and I know personally structure is the main part of my trading philosophy. Everything I do in the market takes structure into account. Trade entries take structure into account. Trade exits take structure into account. Stop losses take structure into account. It is the centerpiece of my philosophy, and I really believe that structure acts like a magnet, meaning prices is pulled towards it and then it bounces off of it. And it can really, it's like a roadmap, in my opinion, to where price is going to go next. So if you're someone that's new to the market, I know there's lots of fancy indicators out there. There's MACDs and RSIs and Bollinger Bands, and there's moving averages and all types of shiny things that you can add to your chart. But in my opinion, it's important to know the basics, and at the heart of everything, right, the backbone of price is support and resistance. It has something to do with market psychology as well, because after all, the price chart is just a visual representation of our actions in the market. So it has to do with where traders are interested in buying and selling at, right? Supply and demand, stuff like that too. But take structure into account. I promise it will change your outlook on trading and on technical analysis. So the question is, now that we've come down to structure, and congratulations to you traders that caught this move. I know a few of you guys did. Well done. Now that we've made our way down to structure, the question is, what are we going to do next, right? If we come into previous structure support, then how am I going to get involved? And you can see we have currently a doji candle right here, more of a bullish doji, but an indecision candle. So what that means is that we are seeing some buying pressure in the market, and buying pressure is a combination of not only buyers, new buyers being interested, but old sellers, taking some profit out as well. And if we go down to the daily, right? If we go down to the daily, I guess first and foremost, what I would be expecting is to see some type of relief off of this level. We already got a little bit, but I think we can certainly see a little bit more up to this blue line. A more conservative level to look for would be right here. But any of these two levels right here would be a decent level to look for some relief. So look for a level that price can retrace to. And there's a few ways you can get involved, right? A conservative way would be looking for a double bottom. We've already come down. You can see our RSI went oversold. We gave a brief retracement. If we do give another retracement right here and we do hold, so we get another clue from the market that there is buying pressure at this level and the sellers aren't easily going to be able to break through, you can trade it based off of a double bottom and use that as a chance to get long in anticipation of a move higher. Now, if you're more aggressive, right? One thing we always talk about, we say good moves don't last, right? And I have a real estate investment business as well, and unfortunately, over the years, we've learned that the hard way, but a good saying that we always say in real estate is good deals don't last. And when a house goes on sale and it's priced really, really, really good, typically it's gone before most people even know about it. And we see the same thing with the markets, right? So very, very strong moves in the market, we'll see V bottoms like this, right? We'll see the market touch the level and then explode right off of it without looking back. That doesn't make double bottoms and double tops bad. It just means it's a more conservative way to enter the market, but there is the risk that you may miss the move. And that's kind of the give and take of trading, right? There's always a give and take. It gives you a more conservative entry, so a little bit more, a better clue that the market is likely to reverse. But you also have the chance of missing the move. If you're aggressive, right? The market can always slam down in your face because you don't get that extra clue. But when the market does make those quick turnarounds, right, those really aggressive moves, you get to be involved. So you just have to match it with your personality, match it with your philosophy. Are you aggressive by nature? Are you conservative by nature? And one of the things that we do with our traders is we try to work with their personalities and fit their trading plan to their personalities. That way there's a less likelihood of them making mistakes. But if we go down to the daily here, and if I just zoom in, it's Friday right now, Friday about 4:30. Just watched Belgium defeat Brazil, right? Another big dog goes down, although Belgium is a big dog themselves, but they fly under the radar when compared to the big names like Brazil. So we still have some time for the market to close, but typically with a half an hour left, we're not going to see too much movement. So I'm going to assume that price is going to close how it is. And if that's the case, what we have here is called an inside bar, right? We have a bar right here, a daily bar that completes fully inside of the previous day's action, right? The previous day's range. And typically when you see these type of bars, you would expect a breakout to come afterwards, right? We'll go down to the lower time frames in a little bit, but essentially this is just consolidation, right? If you can imagine the first day's range being like this, the second day's range is like that. If you go down to a lower time frame, you can just imagine, obviously, the range getting smaller and smaller. And typically when we have consolidation leads to expansion. So I would expect a breakout of this level. Now, the question is, which way is the market going to break out? And that we do not know. There are clues we can use, just due to historical price patterns and their likelihood and having a whole bunch of past data and knowing that if this happens, then we usually see this. But there's no way we can know for sure. And that's something that's very important in trading. I really hate, it really bothers me when I hear traders talk about this will happen, this has to happen. There may be a good chance or a better chance that it could happen, but the market never has to do anything, right? We just never know until it happens. All we can do is make predictions and put ourselves in the right trade where we limit our risk and we try to maximize our reward without being too greedy, of course. But one of the things I would expect from this type of formation is a breakout. And if you're an aggressive trader, what you can do is you can put a buy stop order right above this level and look for the breakout. And that way, if we do get a bullish day, you're involved in the move as soon as it goes up. Now, if you'd rather go down to a lower time frame and get maybe a different perspective of it, you can see this essentially looks like a bull flag pattern where you can see price action made our flag pull on the way up right here. And then we just started consolidating. And you can treat this like the different ways we trade flag patterns, right? We talk about positioning yourself before, positioning yourself during the breakout, or positioning yourself after the breakout. So one of those three ways, whichever way meets your trading plan. Obviously. Now, inside bar strategy, for you guys that have been following me for a while, or at least on the tier 1 platform, you've heard me talk about this. This is something I'm going to work on. This is a strategy I've used in the past that was very, 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 very good, even though I was very, 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 very bad at trading. And it is something that I wanted to bring back for a while now. I just haven't had time to do it because we're working on so much content and so much other stuff as far as education goes. But I talked to our programmer, Anthony, and he just developed an indicator for me to help us identify the type of inside bars that I like to trade, because not all inside bars are good, just a very specific one. So I'm going to plug that in over the weekend, hopefully make sure there's no bugs in it, give him some feedback, have him tweak it for me. And then the next thing on my agenda is to start working on this narrow range inside bar breakout strategy for you. So for you guys that are longer term traders, you can literally come in and look at the price chart once a day, right? And set up your trade, maybe twice a day, once in the morning, once at night, just to be safe. But you can, the point is you can come in and look at your charts for a split second, know if you have a potential trade on the radar or not, and then go about your day. So make it nice and easy for you. So in last week's video, I shared with you an update of my trading and how the month of June was really not a hit or miss month, but a back and forth month that really ended profitable. And I showed you guys an equity curve of my year-to-date trading as well. And that's something that I try to do each and every month for you guys, just to give you an idea of what it's like to be a professional trader, the reality of trading. And I think the problem out there is that so many traders have the wrong perspective on what's available. I was speaking to a trader this morning on Facebook who was saying, okay, well, so I can make, the guys on the internet saying I can make $2,000, $3,000 a day. Is that true? And I responded, well, unless I know someone, I never want to say they're lying, but, most of the people that are saying that, probably aren't telling you the whole story, if there is any truth in that at all. Because the reality of trading, especially in the professional standard, is that you're considered a good trader if you can average 2% a month. You're considered a great trader if you can average 5% a month. And I know those numbers seem very, very small to many of you, but if you compare it to other investments, right, it's really pretty good. And the key with trading is if you can consistently make those type of gains, you can really boost that by adding a proper position sizing strategy. So something I was going to do this week was take my results over the last 5 years, put them together into a spreadsheet, and really show you what the power of money management can do. Maybe I'll do that in the future, maybe in a private Q&A session with the tier 1 clients, or maybe I'll do it here on YouTube, who knows. But if you get the chance, right, go back to the Trading Coach podcast and just listen to episode 13 called The 3,000% Return. And it gives you a great lesson on the power of money management, how it could be used for good, and how it can also be used for bad. But just to give you a little bit of an update on what stood out to me this month in trading, ciphers came back down to earth. Up to this point, I was hitting about 80% on cipher patterns, which was probably about 10% above my norm. But I went 3 for 6. So 3 wins and 3 losses on ciphers this month. That was kind of my most active strategy of the month, and which is 50%, which brung that win percentage down from 80% to about 70% or 69, something like that. Now, with that being said, it was still my most profitable strategy of the month, bringing in the most pips. And really because I combined I had some big losses on ciphers as well, but there were a few ciphers that I took, which I also combined with a trend continuation strategy, and I was able to make much larger gains on the secondary targets. And speaking of secondary targets have still been amazing for me this year. Just to give you some perspective, my average target 1 has been 40 pips. So I typically take targets off at 2 different levels. I have a very conservative target to kind of put some money into the bank and make it a risk-free trade, roll stops to break even and limit exposure. And then I have a secondary target where I try to shoot for bigger gains. And my average target 1 has been about 40 pips, and my average target 2 this year has been about 91 pips. So my average target 2 is more than double my average target 1. It doesn't hit at as high of a rate. Obviously, if it did, I would only take target 2s, but it is hitting at a high enough percentage that it's worth taking, meaning that target 2s are producing more profit than target 1s. And that's something that we spoke to one of our clients about this week. Make sure that your target 2s are outperforming your target 1s, because think about it like this: target 2s are sexy and everything because they're further away, you have those bigger gains, but if they're not producing more profit than target 1, you would actually make more money, right? Wouldn't be as cool. You can't brag about it as much on Twitter or whatever, but you would actually make more money just by taking your full position off at a single target. So always something that a lot of rookie traders don't think about, mainly because their eyes get big for the big win, and they kind of forget that big win doesn't really happen at a high percentage of the time. But aside from that, 79, 80 trades taken this year. So over a 5-month average. I didn't trade in January, taking about 16 trades per month. I got a few questions about how much do I trade. 16 trades per month. So what's that? 4 trades a week? Is my math right? 4, 8? Yeah, look at that, 16. 4 trades a week on average, which isn't a lot. But again, I'm more of I don't want to say a sniper in the market, but I'm very patient with my decision making. I only take trades that I'm supposed to take, and I'm not involved in trading for action. I'm involved in trading for results. What else? Overall, I'm down to about a 59% win rate. I was hitting at about 65% earlier in the year, which I told you guys was kind of above my average. I typically range between 55 and low 60. So 59% I'm perfectly okay with. That's kind of right in my comfort zone. If I ever get below 50, then I know that's a problem. Whenever I get above like 65, I start expecting a drawdown because I know it's too good to be true. I know that doesn't seem like the optimistic thing to say, but understand that I'm someone that's been very consistent in the market for a very long time now. I know my strategy. I know my numbers. I know exactly where I should be. I know exactly where I shouldn't be, meaning that I know my system. I know what I'm supposed to produce, and I'm very consistent with producing it. Lastly, I did get a win on the pound dollar. There's a running joke that my clients have with me. That is, whenever I take a position on the pound dollar, they take the opposite position, mainly because I only have a single win on the pound dollar this year. I have a 10% win rate, so that's pretty bad. But out of the other 9 pairs in my portfolio, aside from the pound dollar, only one more is in the negative. So I've got 7 pairs that are performing very well. I've got 1 pair that is performing not too good, but nothing to get, upset about. And then I had the pound dollar, which has been atrocious, which is horrible. But again, 7 pairs doing well, 2 pairs not doing well. That's the power of having a balanced portfolio, right? You have other pairs that are going to make up for it when one pair is having a bad year or a bad streak. So what else do you guys like to hear? Oh, here's a cool fact, right? So my most profitable strategy so far has been my price action trading. So not advanced pattern formations, those have been doing well, but my price action trading, so counter trend trading, trend continuation trading, head and shoulders, all the fun stuff, not involving the fancy fibs and the triangles, just pure price movement. That's been my most profitable trading strategy for the year. However, I'm only hitting at about a 43% clip. So for you guys that are under the assumption that you have to have a very, very high win percentage in order to be profitable, my most profitable strategy is hitting at about 40%, a little bit above that, and it's still been amazingly profitable. So maybe that will kind of dispel that myth out there. And that's due to average risk reward. Yes, I lose more than I win with that type of strategy. However, when I win, it's pretty obvious that my wins are a lot bigger than what I give back when I lose, and that's purposely done. So I think that's about it. Yeah. So one last thing before I let you guys go, if you haven't done so already, make sure you sign up for the Tier 1 Trading Royal Ball coming December 8th, 2018. We're putting together kind of a year-end celebration. This is our first year with Tier 1 Trading, so we're going to celebrate a successful year by hosting a big party. So if you're interested, just make sure you go to the website. I'll leave the link below. I'll flash the link across the screen as well, but just get on the email list so that you're notified. That way we kind of can gauge the interest in this event. It's going to be a pretty cool event. Again, it's in December. It's going to be at the Alexander House Hotel and Spa in West Sussex, UK. And all the information about the event is going to be down here. You can see it's just going to be an awesome time. So we'd love to have you guys out. Put your email address in if you are interested. And until next time, traders, plan your trade, trade your plan. Good luck in the markets this week.